So good day everyone. Our tackle for today is custom control. What is custom control? Custom control is an authority or agency in country responsible for collecting customs duties and controlling the flow of goods, including animals transport, personal effects, and hazardous items into and out of country. Ibig sabihin daw, sa madaling salita, ang custom control ay nagbabantay sa hangganan ng bansa para masiguro na tama ang mga papasok at palabas na kalakal. Next, three sources of custom control. First is export departure. Second is import destination. And third is transit. And export departure. Development countries that operate in highly sophisticated and system designed to collecting trade statistics, such information being the considerate. Quite rightly as being the vital to economic planning. And export departure. Ang export departure daw, kapag may produkto na iluluwas sa palabas na bansa at tinitipon ng mga customs ang datos tungkol dito, gaya ng uri ng halaga at dami ng produkto. Mahalaga ito para sa trade statistic dahil nakakatulong ito sa pagpaplano ng ekonomiya ng bansa. Halimbawa, kung ang Pilipinas ay may export na saging patungo sa Japan at ang customs ay magre-record kung gaano karami at magkano ang halaga ng saging na inilabas. Gamitin ang datos na ito sa National Economic Report para malaman kung gaano kalaki ang kinikita ng bansa sa pagluwas ng produkto. Number 2, import destination. Custom authorities throughout the world are interested in good entering their terrorist. Ang ibig sabihin ay interesado ang customs sa lahat ng produktong papasok sa kanilang teritoryo. Layunin nito ng kolektahin ang buwis o taripa, suriin kung ligtas ang produkto o siguraduhin na sumusunod na ito sa regulasyon ng bansa. Halimbawa, kung ang isang kumpanya sa Pilipinas ay nag-angkat o nag-import ng kotse mula sa Korea, hindi agad ito makakalabas ng dadaan muna ito sa customs para tiyakin na nagbabayad ng tamang buwis ang importer at ligtas ang sasakyan. Kumbaga, gina-check nila ang mga buwis kung sakto ba, ingana, para ligtas ang mga sasakyan or siguraduhin nga walang anomalya ang nagaganap ng transaction. So next, import control, tariff control or non-tariff controls. Tariff controls, duties, tax, excise, levy, and licensing, and quota. Non-tariff controls, technical standard, medical standards, health and safety standards, and imposed by custom authorities. Other standards requirements, cultural barriers, and national buying habits in each.
These are tariff taxes on imported goods imposed in the aim of strengthening internal businesses. The first one is duty. Duties are used as a specific fiscal control and applied selectively at a variety of levels by different countries, meaning a fee charged on specific imported goods. For example, if a country imports car from Japan, it may add a 10% duty on each car to make locally made cars more competitive. Next one is tax. Tax that standard fiscal charge on all sales, meaning a general sales tax charged on all goods including imports. For example, when you buy an imported phone, you still pay 12% VAT or value added tax like on local products. The third one is excise, sometimes referred to as revenue duty, which accurately describes its purpose in that, rather than acting as a pure control, excise is designed to collect government revenue. So, ang excise is a tax mainly to collect money for government, often on goods like alcohol, fuel, or tobacco. For example, a bottle of imported whiskey may have a excise tax added, making it more expensive. Next is levy. Levies are a specialized charge which generally affects only agricultural products and items processed from them. Levy is a special charge mostly for agricultural imports. For example, if rice imported from Vietnam, a levy may be applied to protect local farmers. The next one is licensing. Many overseas countries, particularly developing and underdeveloped countries, use specific import licensing to control every consignment. Licensing is a permission required before importing certain products. For example, a company wanting to import pharmaceutical drugs must first get an import license from the government. Quota. This describes a quantitative restrictions which may be imposed on certain goods, usually to protect local manufacturers. So the quota is a limit on how much of a certain good can be imported. For example, a country may allow only 100 items of imported sugar per year to protect its sugar farmers. And the last one is standards. Standards exporters will inevitably encounter an enormous range of different technical requirements across the world. So the standard is rules about quality, safety, and technical requirements. For example, imported toys must meet safety standards to ensure they are not harmful to children. So now let us proceed our lesson 2. Explain the export invoice. So the invoice is a document that itemizes goods or services provided and requests payment from the customers, detailing the cost and payment terms. So the invoice is a bill given to the buyer. It lists the items or services sold, their prices, and how payment should be made. For example, if you order 100 items for 5,000, the invoice will be state 100 items times 50 each. So the equal is 5,000 payable in 7 days.
So, export invoice fall in 5 distinct types. The first is a commercial invoice. The simplest the situation is one where the importing country has no special requirements at all, and the exporter uses the standard the commercial invoice just as for a home sales. The normal invoice used for selling abroad without extra requirements. In the examples, a Filipino clothing a company exporting t-shirt to Singapore just issues its regular company's invoice. Number 2, commercial invoice with declaration. It is the quick in common for countries to require the specific declaration to be type 1 the invoice. An invoice that includes the government required the statement or not. Example, when exporting electronic, the invoice might have to say, we declare that these goods are made in the Philippines.
Third, commercial invoice requiring third-party verification. So, ang commercial invoice is mauni siya ang legal document para sa international trades. So, legal documents man siya, ang sulod ana is details sa isa ka product nga ginasbaligya ni seller para sa iyang buyer, including na dito ang information ni seller ug ni buyer, ang description sa product, quantities if pila, then ang pila ang product nga ipadala niya sa seller, then prices, lastly ang shipping terms. So ang commercial invoice mao ni siya ang proof sa sale or a contract, and also declaration sa custom para i-assess ang taxes sa imported nga goods. Then, third-party validation mao ni siya ang ga-confirm sa legitimacy sa invoices for custom purposes, and makahelp po ni siya to ensure nga nag-comply ba ang seller sa mga regulations. Next, certified invoices. The above declarations sometimes require a third party to validate them, and the most common requirement is for a UK Chamber of Commerce to certify a set of invoices. So, ang certified invoices, mao ni siya ang sales invoice nga na-verify na siya officially o na-endorse na siya sa government agency or sa embassy. So kani nga certification mao ni siya ang ga-validate sa isa ka invoice originality o para ma-ensure nga ang details like the quantity or value and the origin sa ana nga goods are accurate para sa custom and international trade. So in short, ang certified invoice mao na siya ang ga-certify sa mga invoices before ma-dispatch ang isa ka goods. For example, ang Bureau of Internal Revenue or BIR, which includes ang details sa seller and buyer information, product description, quantity, price, o ang breakdown sa VAT. Legalized invoices. The procedure is that the exporter arranges certification at the Chamber of Commerce and then presents the document set to the appropriate embassy in London for legalization. So ang legalized invoice mao ni siya ang na certified na or nabut nga na siya stamp sa embassy and ready na siya for its export destination country. So kani nga process ga-verify siya sa authenticity sa usa ka invoice, and mao ni siya ang usually requirements for custom clearance. Ang example ani niya is BIR accredited sales nga ga-serve siya as official document para sa sales, including na dito ang details sa seller and buyer information. Also ang transaction nga dates and detailed list of goods and with prices and tax information. For consular invoices. Consular invoices are particularly common in Central and Latin American countries. They require their own unique consular invoices form to be completed and returned to the consulate for consularization. So ang consular invoices daw isa gyapon ni siya ka document nga ga-include sa details about sa shipment sa atuang goods and products. So kani siyang invoice mo ga-certified pa ni siya sa atuang consular official sa atuang gina-importan nga country and used sa atuang custom authorities para ma-verify nila ato ang shipment value and quantity. So, ang purpose ani is to allow our importing countries, custom official to confirm our shipment details. Fifth, specific customs invoice. These invoice forms are particularly related to ex-Commonwealth countries and are hangovers from the obsolete Commonwealth preference system. There are a lot fewer of these invoices in existence that at one time. Many countries have gone over to a commercial invoice with a declaration. So, ang specific custom invoice, mao ni siya ang document for international shipping. So, by filing this, customs invoice accurately helps our shipments para mo-move siya smoothly and maka-avoid siya og delays and extra fees. So, ang example ani niya is package contents with description and the recipient details. Lastly, the three vital pieces of information that the custom authorities at the destination need to apply import controls are: first, description. This is the starting point for all the custom controls, as the goods must first of all be very specifically identified to decide what particular controls apply to them. Second, origin. Once overseas custom have accepted the tariff classification or reclassified the goods themselves, then the tariff will indicate the range of controls such as duty, tax, license, and quota, which apply to each particular commodity. Lastly, value. Once custom have decided on the description and the correct origin of the goods, then it may be the case that ad valorem changes are applicable. In such a case, the invoice value, often referred to as transaction value, serves as the base for the calculation of charges.